What is going on, guys? My name is Darren Jackson. Welcome back to the channel, or welcome if you're new. I really appreciate you stopping by. That's awesome. And today we're going to talk about rates. Now, if you are a regular subscriber to my channel, then you know that I've talked about rates before. So unless you love hearing me speak, which I appreciate, or if you're new and you may not really understand what a rate is or why it should be super significant to have rates in your portfolio, especially as a new investor and especially as someone that wants passive income, this is definitely the video for you guys. So a REIT is a real estate investment trust, and a company that's a REIT is basically a company that owns, operates, and or finances income producing properties. So that could range from houses to restaurants, offices, gyms, metropolitan buildings, pretty much anything that somebody can be leased and that company can get money off of. So in order for a company to be considered a REIT in the stock market, there's a lot of boxes they have to check off. But out of all those boxes they have to check out, the one I feel like is the most important for stockholders to receive passive income is the fact that those companies have to contribute 90% of their taxable income to the shareholders in the form of annual dividends. That's why I really feel like REITs are really significant as far as passive income. But with that being said, you're not really going to get a lot of capital appreciation. There are a couple of REITs that actually do that, and I've talked about those before, but I'll get into that in a second. All right, so now that we know more about what a REIT is, we're going to talk about two different REITs that I have in my stock portfolio right now. One of them I've talked about before in a previous video, but I didn't go over the financial details, so I'll make sure I do that. And the other one I've never talked about before, but I finally invested into it about a month or so ago, and it's actually a pretty interesting REIT. And neither one of those is realty income, and I say that because realty income is probably the best REIT out there, at least if you ask me. But I've talked about it before, and if you guys are interested to learn more about realty income, make sure you click this link above. But as far as talking about these REITs, we're going to go over what type of properties these REITs have and the style of tenants that they have, whether they're single tenants or multiple tenants. We're also going to go over, again, the financial details as far as the stock price around this period of time. Today is, for me, is Wednesday. So we're going to go over that, the dividends they pay, and then we're going to dive into the performance on a financial basis that they've had over the past 5 years, including how they've been impacted over this recent, or actually current, pandemic. So with that being said, guys, the first REIT that we're going to talk about today is STAG Industrial, which is a REIT I've talked about before, and they are a REIT that manages single tenant industrial properties. Having a single tenant, in my opinion, is pretty significant because it eliminates the confusion of conversation. There's no middleman. It's just the person that is renting the property and the landlord. So it's STAG Industrial and the tenant in the industrial property. Now, it took me a while to figure out what type of companies that STAG Industrial is having communication with, but I found out that their biggest client, their biggest industrial property, is owned by Amazon. So that's really important. That's going to be really important when we talk about the financial details of it. Another thing with STAG Industrial I thought was really cool is that before STAG Industrial actually agrees to terms with the tenant, they kind of go over a credit check, I guess, if you will, with the tenant. Ultimately, they want to make sure that that tenant is good enough to be able to sustain a long-term contract, which is really beneficial for us as shareholders. It gives us a state of mind that we're going to receive more passive income over a long period of time. And it's really beneficial for STAG because if you average out all their contracts for all the tenants that they have, the average contract lease is about 8 years. So that is actually really cool. Now, speaking of the passive income, STAG Industrial right now ranges between $28 and $30 per share. And they have a monthly dividend of 12 cents per month, so that's about $1.44 a year. They have had an increase in their monthly dividend, but not really significant. We're talking from 0.119 cents to about 12 cents. It is an increase, which is great, but pretty small. And their performance over the course of 5 years, I believe they've gone up about 60% over the past 5 years, which is great. But of course, they were impacted by this recent pandemic. And I'm pretty sure that's just because, for one, all companies, or almost all companies, were negatively impacted, especially during February and March. A lot of people weren't spending money because a lot of people were unfortunately losing their jobs. But considering the sector that STAG Industrial is in as far as the tenants that they have, including Amazon, companies like Amazon and other industrial companies that they may not actually manage, such as UPS and FedEx, they're still considered essential companies. They still have to ship out things because people are still ordering online, and there's still essential needs that other essential companies need to ship in, such as hospitals and medical supplies. So I think that minimize the losses for them in comparison to other REITs, including the other one we're going to talk about today. and that's helping them recover a bit more and go back to regular prices and then some. The second REIT that I recently just added to my portfolio is Store Capital. If you guys watch Tyler Hill's YouTube channel, you know that he talks about it all the time, and I finally, a couple of months ago, decided to look it up, and it's actually a pretty cool rate as well, so I invested into it. Now, Store Capital acts as a single tenant real estate investment trust. They are so hyped about the single tenant aspect of it. As a matter of fact, I believe STORE and Store Capital stands for single tenant operation or operational real estate. And on their website, they express how they act as a single landlord, similar to what STAG Industrial does, just to, again, eliminate the confusion between tenant and the landowner. So that part's pretty beneficial as well. What's also pretty interesting is the actual properties that they own. They're a bit different from a lot of other REITs that may own offices and stuff like that and industrial buildings. They go towards places such as gyms, restaurants, daycares, family entertainment clubs, and movie theaters. It's beneficial on one end because there's not a lot of other industries that are going to distract them, but at the same time, that kind of gives you an idea of how they've done over the past 5 years or so, including what's going on this year, but we'll get to that in a second. Now, Store Capital is currently worth about $30 to $32 a share at this point in time, and they pay a quarterly dividend of 36 cents every single quarter, which is actually really similar to STAG Industrial because STAG pays 12 cents a month, which is equivalent to 36 cents a month. Simple math, man. It takes you a long way. I just realized that. And they've also increased pretty slightly. I think in July, they were about a cent lower on quarterly dividends. So again, small increase, but an increase nonetheless, so it's really good. But what's not really good is their financial history over the span of 5 years. So Store Capital is on the positive end right now. They've grown to about 40%. But pre-pandemic, they looked significantly similar to STAG Industrial. They were about 60% increase over the past 5 years. But they were hit pretty hard with this current pandemic. And that's definitely because of the type of tenants that they have. When you have this pandemic and people don't want to spend money, then you're not gonna see a lot of people at restaurants, you're not gonna see a lot of people go to movie theaters, and especially with a pandemic going on, not wanting to get sick, you were gonna see a significantly less amount of people going to movie theaters and daycare centers and restaurants and gyms. So they took a really huge hit within February and March. But considering those types of places, I guess with the exception of movie theaters right now, considering everything going on, all the changes that are being made, those places were the first to recover, especially restaurants. So that's really significant in proving why they're recovering so much in between July and up until now. So I do believe that they're going to recover overall. And again, in July, they were able to increase their quarterly dividend. It was a really small increase, but if they were losing so much money, they probably wouldn't have increased it at all, let alone more than likely decrease it. So there's a lot of signs of life with this rate. All in all, I feel like these two rates and a lot of other rates are really significant, especially for new investors to research and add to their stock portfolio, especially if passive income is really important to you, considering that a lot of monthly dividend paying stocks in the stock market right now are in the rate category. So it's definitely something you want to look out for. But let me know, guys, do you have any rates in your stock portfolio right now? And if you do, what is your favorite? Please let me know in the comments below, and leave a like if you enjoyed this video, and make sure you watch some of these other videos I've made. I really do hope they help you on your investing journey as they have in mine. I appreciate you guys watching, and until next time, take care.